Hello, welcome back to the continuing lecture in cash flow analysis. So this is the second video in this topic. So in our previous topic, we looked at the two cases of cash flow analysis, two individual, personal, right? Cash flow analysis on personal level to individuals, but of course that was a simplified version, right? Because in general, individuals or people don't keep financial statements, right? They don't compile balance sheet, or they don't, individuals. I myself don't compile, income statement or balance sheet or cash flow analysis. I could do that too, but there's one reason, one practical reason why I don't do that. I mean, it's all related to tax, right? Of course, when the tax season comes around, I can do my taxes, but then, sometimes I take it to the CPA because they know these little tricks, that can, or loopholes, I can, save a lot of taxes, and especially if, as an individual, you have no leeway, and you have to do it filing taxes as an individual, right? A single person or married filing jointly, you really don't have that much leeway. But taxes for businesses, there are several, even, this is not illegal, legitimate, legal tax shelters, or so it's all related to operating depreciation and operating expenses, and also related to inventory valuation. But as an individual, you don't have those tools, right? In other words, you don't have inventory, you don't have, depreciation, business asset. I mean, depreciation is only applicable to business asset. And as I said in the previous lectures, depreciation means, not in everyday usage of the word. I mean, everything depreciates, of course, but if it is a business asset, there is a tax shelter, right? That comes from depreciation, right? But for individuals, there's no nothing like that. So there's no incentive to keep a financial statement. I mean, if I want to, I would. But anyway, the point is, so now we are going to look into the cash flow analysis of a firm. Previously, it was just, individuals. So let's see, let's take a look at this company's income statement and balance sheets. Belfry Company. So you understand we need two balance sheets and one income statement. So we have balance sheet at the end of the year 1 and balance sheet at the end of the year 2. So that's 1 year, right? And the income statement. And this is still very simplified version, because an income statement of company cannot be this simple. But we are just simplifying everything. First of all, let's take a look at their assets and liabilities and equity. So they had cash of 1,000 at the end of year one, and cash increased by 400. Now, if this is a business, usually all the numbers are in thousands, right? All the numbers are in thousands, so that means 1 million, 1.4 million, right? They had accounts receivable of 3,000, 2.9 thousand at the end of the year, so accounts receivable actually went down. And whether this is a positive signal or negative signal, we're not going to repeat this because we talked about this in the previous lectures. Inventory at the end of the year increased. Current assets increased. Overall, when assets increase, that's a good thing, right? Current assets increased. Fixed assets, gross fixed assets. This means change in fixed assets, right? Gross fixed assets increased. That's a good thing, right? Yeah. Fixed assets means plant equipment, so that means bigger plant and equipment size means bigger production capacity, right? Depreciation, accumulated depreciation until that point, in year one, 1,000, 1.5 K in year two. So net fixed assets still, good. There's an increase in change in net fixed assets, and so the total assets increased, by 3,000. That's a good thing, right? Good news. So that also means, liabilities and equity also increased by 3,000, right? Because they have to be balanced out. Take a look at liabilities. Liabilities increased, and of course, whether it's a good thing or bad, positive, if the implication is positive or negative, I won't repeat we already did that in the previous lectures about the capital structure and balance sheet, right? So, but one thing is for sure, then, if the liabilities increase, that means it's increasing cash flow, right? Now, accruals decreased, okay? So the current liabilities, overall increased by 500. And then long-term debt increased from 5,000 to 6.2 K. And the equity increased to 3.3 K, right? From 2K, 3.3 K. This is a good thing, when equity increases, generally it's a good thing. But once again, from the capital structure perspective, too much equity is not necessarily a good thing, right? It may decrease or deviate. It may make the capital structure deviate away from the optimal capital structure. Now, so the total capital. Now, why don't they call it total assets? Because total assets would be equal to total liabilities and equity. Total capital, I've been telling you, when you call capital, when you say capital, it only refers to the long-term capital. Okay, not In other words, it's all about only long-term debt and long-term debt and equity. It's not doesn't include short-term debt. Okay, so long-term capital increased by 1.5K. Right now, the liabilities and equity increased also by 3,000. Right. So what happened during the year? Let's look at the income statement. So they made sales revenue of 10K. CGS. Some books use COGS, cost of goods sold, but it's like it doesn't matter. I prefer CGS because it's like USA. We know USA stands for United States of America, but we don't. When you use acronym, right? The acronym is USA, not USOA, right? So COGS is just like USOA. So that's, I don't know. To me, that sounds that sounds dumb, right? Um, Of is not that important. I mean, of is only a conjunction, right? Or or what preposition, or what's preposition is the better word, but now anyway, so gross margin is another name for that is gross profit. But I've been telling you, I've been warning that this is not true. This is not really true measure of profit. That's not true measure of profit because it can be misleading. I've been here, right? It's just because revenue minus CGS, but that's not the reliable level of profit, right? A true level of profit is EBIT. I mean, the first line of profit is EBIT, right? We're talking now so expenses, which means operating expenses, of course, but operating expenses already includes depreciation, right? So I lump them together because usually under operating expenses, depreciation is a line item. Two sources of cost, CGS and OPEX, right? So the total OPEX, right, is like 2.1K. Now, if you subtract that from gross profit or gross margin, EBIT or operating income, operating profit is 1.9K. You make interest payment, EBIT is 1.5K, and taxes are like this, and net income is 1,000. Usually, the income statement stops at net income. Okay, if they pay out dividends, right? It is normally recorded in the statement of equity or retained earnings statement. You don't have to but according to the scenario of this example, they paid dividend. So just to make it easier for you to follow, I put the dividend here. Okay, but usually they just show stop at net income. So that's why if you follow, we're gonna so if you look at the equity, the change in equities looks like 1.3K, 1,300. So question is where did that 1,300 come from? And None of that is discussed here, but once again, if you look into like retained statement or a statement of equity, it would be all detailed. So let's take a look at cash flows by the activities, right? Remember, there are all firms engage in three types of activities, right? Operating, investing, and financing. So let's take a look at the cash flow from operating activities, and it's also called, operating cash flow, right? There's a difference between net income and operating cash flow. So we know net income is 1,000. There was a depreciation of 500. Now, it's important. Net income may not be all cash, but most of it eventually will be cash, right? Because if there are receivables, right, you can convert it into cash, right? And then depreciation. You think depreciation is an expense? Yes, it's recorded as expense, but we went into a pretty much detail, pretty extensive detail about what depreciation means and why it is not its expense, but it is a hollow expense. In other words, it's just a like a phantom expense. I mean, there was cash layout. In other words, you paid cash at some point at time zero, right? But in the following years, because you already made payment, you already expended cash at time zero. There's no cash payout in year 2, 3, 4, 5, but you just spread it over. So actually, depreciation is a preservation of cash, right? So that's why it is a cash inflow, right? Everything that is positive is cash inflow, right? And then net change in current accounts. Current accounts means current assets, current liabilities, and current assets minus current liabilities is also called net working capital, right? Net working capital, right? So change in net working capital, right? Which is change in current asset minus change in current liabilities. Okay, so that was negative 600 means cash outflow. So if you add them up, right? There was $900 cash inflow from operating activities, and this 600 negative 600. What is the detail? I mean, where does it come from? So there was accounts receivable of 100, inventory you had to spend payout, so 1,200. There was increase in payable. I'm sorry, 600. Now remember, accounts payable is preservation of cash preserved, right? And payable increased by 600, accruals decreased by 100. So if you do do the math, it comes to a negative 600. Once again, accounts receivable, right? Decreased by 100. Decrease means source of cash, right? because you received cash, they paid you, right? So account receivables went down. Payables increased by 600, right? Again, increase payable is, cash preserved, right? Accruals went down by 100. That means cash was paid out, right? So they all add up, right? Cash was paid out. So that's now next from like investing activity. So they purchased $2,000 of fixed assets, something like equipment, right? So cash, so paid out cash. So cash went down by 2,000, and cash flow from financing activities. So long-term debt increased by 1.2K, which is basically cash inflow, right? They sold stock. That's also cash inflow, but dividend was paid out. Was cash outflow. So overall, cash from financing activities is from 1,500, right? From 2,000, right? So yeah, this is why I put like this. There was a dividend, right? Now equity increased by 1,300. Before paying out dividend, it would have been but after paying out dividend, right? 500 is added, right? To because only 500 is the retained earnings, right? After paying out dividends, right? And then they sold the stocks, right? So 800 is the proceeds from sale of stocks, right? So the so that's why it is showing increase of 1.3K. Okay, now and then you might wonder, oh, then it's cash from financing activities is 1.5, increased by 1.5, but why is 1.3? We're only looking at the equity. Look at the long-term debt, long-term increase, the long-term debt increased by 1.2K. So that 300K is that I'm gonna I'll look into that. That was so here. So from equity and cash accounts, right? There was net income of 1,000, right? And stock sale of 800. Proceeds from sale of stocks 800. Dividend, they paid out dividend. So change in equity is clear. It's 1.3, right? And the cash balance at the beginning there was 1,000. There was net cash flow of 400, and therefore ending cash balance is 1.4K. So we put them all together in one big so net income, cash from operating activities, overall, 900, right? Got that. Cash from investing activities, negative, right? 2,000. Cash from financing activities, right? Yeah, 1,500. That 1,500 is just the overall cash from financing activities. It's not necessarily, only, it doesn't have to. It's not necessarily only, equal to the change in equity. And the change in equity was, 1,000, 300, as you could see. So, net cash flow was 400. So, because actually they should have put it at the bottom, right? This for net cash flow, so basically, if you look at these numbers, that's the that describes the the net cash flow of this company. Now, so that also, think about it. The cash balance, the cash balance ended in 1,400. So the net cash flow was positive 400. But think about it. That is the result of, right? That's the result of positive cash flows or cash inflows. How much cash inflows did they have? 900, 1,500. So that's 2,000. 2,400. And then there was cash outflow of 2,000, right? So that is then the net cash balance is 400. I mean, it explains where this 400 came from, right? In other words, right? $24K, and then minus 20K. 2.4K, I'm sorry, 2.4K minus 2K, right? And 0.4K. And then that 0.4K That is what means this net cash flow, right? All right. So now, as we were um, looking into this cash flow analysis of Belfry Company, there were a few concepts that came up. Um, First of all, the concepts like operating cash flow came up, right? Remember? And I said operating cash flow is different from EBIT, right? Because operating cash flow sounds like operating income, but actually there's a difference between operating income and operating cash flow, right? So, what is operating cash flow? Is not net operating income, which is EBIT, right? So operating cash flow is usually greater than EBIT because, first of all, you are adding to, basically EBIT, you're adding depreciation, right? Now, eventually, all the companies, all the firms, are pursuing their, they are perceiving as their return, what they perceive as their ultimate cash flow is the free cash flow, which is the cash flow available to actually, if they want to distribute, that's the cash available to distribute. Of course, there are two types of free cash flows. Free cash flows can be either free cash flow to the firm, free cash flow to equity holders. But so in other words, free cash flow to the firm and free cash flow to equity holders. And we are talking about, basically, free cash flow to the firm now at this point, right? So this is basically operating cash flow, right? And then operating cash flow minus investment in operating capital. What is operating capital? Operating capital is changing gross fixed assets and changing net working capital. What is the source of cash to support, to fund the change in gross fixed assets? Changing gross fixed assets is basically, like acquiring new equipment, new plant, and things like that, or decrease thereof, right? But if they are acquiring new, right, plant and equipment, what's the source of funding for that? It has to come from operating cash flow, right? And also change in net working capital. Remember, net working capital is, right, current assets minus current liabilities, right? So if there is an increase in current assets, in other words, if there is an increase in net working capital, where should the money come from, right? What is funding that increase in net working capital? The source of all that is, operating cash flow, right? So these, I don't like verbal definitions. I've been telling you over and over, verbal definitions are always nebulous, it's blurry, right? It cannot be clean cut and close ended. But if it is defined mathematically, it is always clean cut and indisputable now, and closed-ended. So no matter what they say in verbal, form, right, it's useless, right? Uh, Cash generated beyond blah blah blah. But if it is defined mathematically, right, uh, it's infallible. Okay, so that's it for this segment of the video, and I will see you in the uh, next lecture and next topic. Thank you for watching. That concludes the lecture on cash flow analysis. Thank you.